Welcome to the series What is Money, where we explore the history of means of exchange, from the barter system to precious metals, coinage and modern money. Out of the chaos of a fallen Roman Empire, a new power was born not on land, but from the sea itself. The Republic of Venice emerged from the waters, representing a new dawn for the Mediterranean. For centuries, the economic and cultural life of Europe had been overshadowed by the Byzantine Empire in the east. But from the 9th century until the 1500s, Venice would rise as a great trading power, mastering the very mechanisms of money and laying the financial groundwork for the European Renaissance. The origins of Venice can be traced to the chaos of the 5th century, when the invasions of Attila the Hun forced the people of the Veneto region to flee their homes and take refuge on the isolated, defensible islands of the lagoon. This dramatic founding had a profound leveling effect on the new society. Unlike the old Roman aristocracy based on succession, the Venetian elite became a meritocracy built on skill, cooperation, and commercial acumen. Family-based cooperatives, regulated by law for the common good, formed the core of the Republic's business life. This spirit of partnership was perfectly captured in the colleganza, a business structure Venice borrowed from Muslim traders. This ingenious arrangement involved two partners: a traveling partner who undertook the risky sea voyages, an investing partner who provided the capital and remained in Venice. Profits were shared, but if the venture failed, the financial loss was borne entirely by the wealthy investor. By placing the risk solely on capital, the colleganza democratized maritime enterprise, allowing ambitious but less affluent citizens to become merchant captains, thereby fueling social mobility and extraordinary economic dynamism. In the early 8th century, with Italy's population at a historic low, Venice made a bold and defining decision. It was a foundational act of rebellion. Venice openly defied a Byzantine ban on trading with the Arabs. The rewards for this high-stakes gamble were astronomical. The profits from trading with partners like Alexandria were hundreds of times greater than anything Venice had earned under Byzantine restrictions. This flood of wealth, secured through its own initiative, laid the financial foundation for centuries of prosperity and allowed Venice to discover and exploit the fundamental secret to its incredible power, the money system itself. The secret to Venetian wealth: mastering the gold-silver exchange. Venice's ascent to becoming a financial superpower was not just a story of trading goods, it was a story of mastering money. Venice's genius was to weaponize a simple but powerful arbitrage. The central pillar of its economic strategy was the brilliant and sustained manipulation of the gold-to-silver exchange rate between the East and the West. For centuries, the entity that controlled this rate effectively dominated the economic life of Europe. By trading directly with the Muslim world through Alexandria, Venice bypassed the Byzantine Empire and gained access to a much more favorable exchange rate. The difference was staggering. Through Alexandria, Venice could acquire one gold piece for just 7 pieces of silver. Trading through its rival, Byzantium, would have required 12 pieces of silver for every 1 gold piece. This nearly 40% discount on gold allowed Venice to systematically drain the precious metal from the East and accumulate immense capital in Europe. This constant inflow of gold, paid for with European silver and other goods, fueled the Republic's growth and power. Venice became the indispensable middleman between two worlds, facilitated by the ancient Canal of Arsinoe, a precursor to the Suez Canal, which allowed its ships to bypass Byzantine-controlled routes. The trade flowed in two directions. From east to west, Venetian merchants imported high-value luxury goods from the Orient, including spices, silks, perfumes, and medicines. These were then sold across the continent, turning cities like Pavia into major European commercial hubs. From west to east, to pay for these goods, Venice exported European products. The most important of these exports was silver, along with slaves, wood, and iron. This lucrative system generated immense wealth, and with great wealth came the need to protect it. To secure its trade routes and defend its economic dominance, Venice had to become a formidable military and industrial power. Building an economic empire, fleets, crusades, and conquest. To protect its commercial empire, Venice required a navy second to none. The Republic transformed itself from a city of merchants into a major maritime power, capable of projecting force across the Mediterranean. At the heart of this transformation was the Venetian arsenal, founded in 1104. It became the industrial heart of a maritime empire, the largest and most efficient shipyard in Europe, capable of assembling a warship in a single day. To organize and protect its commerce, Venice developed the Muda system, state-organized convoys of ships that sailed together to specific destinations at set times of the year. This system allowed merchants to share the costs and, more importantly, the risks of long-distance trade. Venice's involvement in the Crusades was driven not by religious fervor, but by cold, hard economic calculation. The Republic shrewdly abstained from the First Crusade, unwilling to jeopardize its profitable trading relationship with Alexandria. Its stance changed dramatically by the Fourth Crusade in 1204. By this time, Venice's primary monetary and commercial rival, Constantinople, had allied with Venice's enemy, Genoa. Seeing an opportunity to eliminate its competition once and for all, Venice joined the crusade with a clear business objective: the destruction of Byzantine economic power. The sack of Constantinople was less a holy war and more a brutally successful corporate raid. Venice's fleet was essential to the conquest, and its reward was immense. The Republic secured an advance payment of 85,000 silver marks. Half of all the loot plundered from the city, totaling an astounding 900,000 silver marks for Venice. Political control over half of the conquered Byzantine territories. The most valuable prize of all, secret control over the gold-silver exchange rate with the East. This was more valuable than all the looted treasure combined, as it allowed Venice to perpetually and systematically drain wealth from the entire European continent through arbitrage, making the 900,000 marks seem like a mere down payment. This catastrophic event for the Byzantine Empire was the catalyst for Venice. Flush with silver and free from its primary rival, the Republic was finally ready to forge its own currency and establish a new monetary order in Europe. Part 5: The Venetian Mint, Forging a Global Currency. Before the fall of Constantinople, Venice had been remarkably timid about minting its own coins, preferring to use the established currencies of its trading partners like Byzantine gold coins, Muslim dinars, or Frankish silver. After 1204, this changed forever. Armed with a mountain of plundered silver and unrivaled economic power, Venice began minting its own currency, which would soon dominate international trade. The evolution of Venetian money occurred in several key stages. The first minting between 1172 and 1178, under Doge Ziani, Venice produced its first coins, the small silver denari, containing 1/10 of a gram of silver, and the mezzo denaro, a copper coin minimally alloyed with 5% silver for small transactions. The silver grosso post-1204, using the spoils from Constantinople, Venice minted the grosso. This large coin, containing 2.14 grams of fine silver, quickly became the most widely used and trusted silver currency in Europe. The gold ducat in 1284, with the Byzantine currency system in ruins, Venice stepped in to fill the void. The Venetian ducato was a gold coin designed to carry on the tradition of the old Byzantine gold standard, cementing Venice's role as the new monetary authority. The Venetian Mint, known as the Zecca, was a state-owned institution operated with incredible discipline. It was strictly regulated by a law established in 1278, which ensured stability and trust. Low fees, minting fees were kept very low, around 0.8%. State profits, all profits from minting went directly to the Republic. Tight security, the mint's officials and even its master engravers were subject to strict controls and short terms of office to prevent corruption. By creating a stable, reliable, and state-controlled monetary system, Venice established itself as the financial center of Europe. But this very success would soon expose it to new and dangerous threats, not from foreign enemies, but from within. Speculation, crisis, and a dangerous reversal. With the stabilizing influence of the Byzantine Empire gone, the gold-to-silver exchange rate, which Venice had so skillfully exploited, became highly volatile. Between 1250 and 1360, the ratio swung wildly from 8.5 to 1 to a high of 14.2 to 1, before falling back again. This instability, combined with the greed of private speculators, created a series of profound crises that threatened the foundations of the Venetian economy. The Republic faced two major internal attacks on its currency. The crisis of the Piccoli, 1317 to 1318. Private mints began flooding the market with enormous quantities of low-value silver coins called Piccoli. This debasement created chaos as merchants began refusing the worthless currency, threatening to grind daily commerce to a halt. The crisis became so severe that in 1321, the state was forced to abolish their use in all payments, drastically reducing the money supply. The Banker's Gambit, 1327 to 1328. A cabal of powerful bankers, anticipating that renewed trade with Egypt would soon bring an influx of cheap gold into Europe, executed a calculated move to rig the system in their favor. They successfully lobbied for a law fixing the gold-to-silver exchange rate at a historic high of 14.2 to 1. Their motive was simple: this allowed them to pay off their substantial silver-denominated debts using the soon-to-be cheaper gold. The bankers' law was a catastrophe for the Venetian monetary system. By officially overvaluing gold, it made silver artificially cheap. In response, silver vanished from circulation as merchants and speculators massively exported it to Constantinople and other markets where it was worth more. By 1335, the Venetian silver grosso, once the bedrock of European commerce, had become a rare coin and was no longer a common means of payment within Venice itself. In this, Venice showed greater pragmatism than its rivals. Florence, for example, had tried to fix its exchange rate by law, only to see its policy quickly fail under speculative pressure. Venice, by contrast, rarely fixed the ratio. Understanding its flexibility was a commercial advantage. As predicted, the reopening of trade with Egypt led to a huge influx of gold into Europe, causing its value to plummet relative to silver. At this moment, Venice made a dramatic policy shift that would upend the entire European economy. Where it had once imported gold from the East, it now began a massive campaign of exporting silver to the East in exchange for gold and spices. This was the same strategy the Byzantine Empire had used for centuries, but its effect on a Europe now dependent on Venetian finance was devastating. Venice's new policy had a catastrophic effect on the rest of Europe. By systematically exporting the continent's silver to the East, Venice effectively hoovered up the very metal needed for daily commerce, creating a continental silver famine to feed its own trade with the Orient. While large-scale finance could be conducted in gold, the small transactions that powered daily life ground to a halt. The crisis reached its peak in the mid-1400s, when a severe lack of silver forced mints across Europe to shut down. The situation grew so dire that in the 1470s, both Naples and Venice were forced to mint coins of pure copper, the cavalli and bagatini, just to facilitate basic trade. This unprecedented crisis, however, forced Venice to confront a radical question: did money have to be made of precious metal at all? Glimmers of the future, Venice's experiments with fiat money. Despite its deep-seated reliance on precious metals, Venice's history includes fascinating, if cautious, experiments with abstract forms of money. These episodes can be seen as early steps toward the modern concept of fiat currency, money whose value is based on law and trust rather than its physical content. An early, impromptu example occurred during the Siege of Tyre in 1122. Having run out of funds to pay his soldiers, Doge Domenico Michiel created a temporary currency from stamped pieces of leather, promising to redeem them for real silver and gold upon their return to Venice. The leather money functioned as intended for the duration of the campaign. However, because its value was not legally enforced, nearly everyone chose to convert it back to precious metal once home. More formal experiments took place under Doge Andrea Dandolo in the mid-14th century, representing a conscious attempt to reintroduce the Roman concept of nomisma, money valued by law. The Tornacello of 1353, this coin, a mix of copper and silver, was created for circulation in Venice's overseas territories. Crucially, its legal value was set at double the value of its actual metal content. Its value collapsed not simply from overproduction, but from a crisis of public trust. The local populace, ignorant of the principles of nomisma, grew fearful of being paid in this currency and demanded a 20% discount, a move that fatally undermined confidence in the coin. The Grosso Stellato of 1379, this was a new silver coin, nearly identical to the old Grosso, but stamped with a small star. By law, it was valued at double its predecessor. While these coins were early forms of fiat money, Venice never fully committed to the system. The Romans had successfully circulated coins with a legal value at least 4 times greater than their metal content, but Venice hesitated. The Republic, for all its power, lacked the absolute political authority of the Roman Empire. It did not believe it could force the universal acceptance of a currency so far removed from its intrinsic worth. Before these monetary experiments could develop further, the world changed, and Venice's time at its center was coming to an end. The decline and legacy of a financial superpower. Venice's incredible financial ingenuity was ultimately tied to its unique geography, which gave it a monopoly over the trade routes to the east. But this geographic advantage, the very source of its power, was about to be rendered obsolete. The beginning of the end came when Portuguese explorers successfully navigated a new sea route to the Indies around Africa's Cape of Good Hope. This historic achievement broke Venice's stranglehold on the spice trade. The economic collapse was swift and brutal. By 1503, the Portuguese were importing over £2 million of spices annually via the new sea route. In the same period, Venetian trade through its traditional hub in Alexandria fell by a staggering 75%. The year 1507 marks the official end of Venice's reign. In that year, the Republic lost control of the gold-silver exchange rate, with power decisively passing to Portugal and the new commercial centre of Antwerp. The history of the Venetian monetary empire offers powerful lessons. While Venice masterfully managed the gold-silver ratio and pioneered financial tools like public debt, its experiments with nomisma remained cautious. Lacking the absolute authority of ancient Rome, it never dared to enforce a currency value far exceeding its metal content, a limitation that constrained its options when its geographic monopoly finally shattered. Thank you for joining us in this episode of What is Money? We look forward to having you back for the next episode. Please like and subscribe for more stories like this.